This image represents the bullish 3-drive pattern, which is a powerful harmonic trading pattern used by professional traders to identify potential market reversals. Let's break it down step by step for a clear. The pattern starts from point X, where the price makes its first downward move to point 1. After this drop, the market makes a corrective pullback to point A, retracing approximately 61.8% of the initial downward move. This retracement level is a key Fibonacci ratio, and it helps confirm the harmonic nature of the pattern. From point A, the price again falls sharply to point 2, and this decline is not random. It usually extends to about 127.2% of the XA leg. Once the market reaches point 2, another corrective move occurs toward point B, which again retraces about 61.8% of the previous decline from A to 2. Finally, the third and last drive down happens, taking the price from point B to point 3, and just like the previous legs, this move also extends to about 127.2% of the AB leg. At point 3, the pattern is considered complete, and this is where traders prepare to enter a buy position. The reason is that the 3 consecutive harmonic drives indicate exhaustion in the bearish momentum, and a strong bullish reversal is likely to follow. In the image, you can see that the suggested buy entry is marked just above point 3, while the stop loss is placed slightly below point 3 to protect against any false breakouts. The take-profit target is set in the upward direction, aligned with the expectation that price will reverse sharply after the completion of the third drive. In short, the bullish 3-drive pattern is a textbook example of how Fibonacci extensions and retracements work together to signal a potential turning point in the market. It requires patience and precision, but when identified correctly, it offers a high-probability trading setup. Traders use this pattern not only in forex but also in stocks, indices, and cryptocurrencies because of its strong reliability in spotting market reversals. We're going to talk about one of the most reliable harmonic reversal setups, the bearish 3-drive pattern. This pattern is a strong indication that the market is overextended and ready for a reversal. Let's break it down step by step so you can understand not only how it forms, but also how to trade it profitably. As you can see in the diagram, the pattern begins at point X, and the market makes its first strong bullish leg up to point 1. After this upward move, price pulls back to point A, and this retracement usually lands around the 0.618 Fibonacci level of the initial leg XA. This is our first clue that the market is respecting Fibonacci ratios, which is a key feature of harmonic patterns. From point A, the market rallies again, creating the second drive up to point 2. This second bullish leg is often an extension of 1.272 Fibonacci compared to the XA leg. Now here's where psychology comes in. Traders and investors see this as continued bullish strength. But what's really happening is the market is becoming overstretched. After reaching point 2, price retraces once more down to point B, and just like before, this retracement typically measures about 0.618 of the prior upward leg. Finally, we get the last push, the third and final drive up to point 3. This is usually a 1.272 Fibonacci extension of AB, and it completes the 3-drive structure. Now here's the important part. When we reach point 3, the market has already made 3 consecutive bullish drives, each time reaching exhaustion and pulling back. This repetition signals that buying pressure is weakening and sellers are about to step in. The trading strategy here is very straightforward. At point 3, traders look for a sell entry. The stop loss is placed just above point 3 to protect against false breakouts. For the take-profit target, traders often aim for a move back down toward the previous retracement levels, or even lower, depending on the overall market structure. The beauty of this pattern is that it gives a clear risk-to-reward setup, because the stop loss and profit target are well defined. Why does this pattern work so well? Because it reflects market psychology. Each drive up attracts late buyers who think the trend will continue, but after 3 strong pushes, the market simply runs out of fuel. The Fibonacci ratios confirm this exhaustion, making the reversal much more predictable. So in summary, the bearish 3-drive pattern is not just a random setup, it's a combination of Fibonacci precision, market psychology, and price symmetry. Learning to identify it on your charts can help you catch reversals early. Get in before the crowd and trade with confidence. Here we have a real chart example on the AUD-USD pair. 5-minute time frame showing a bullish harmonic pattern, most likely a bullish bat or bullish Gartley variation depending on the exact Fibonacci measurements. Let's break it down. The red shaded areas highlight the harmonic structure. It begins with the first leg where price pushes down, forming the initial bearish move. After that, price retraces upward, creating the first corrective swing. Then we get another push lower, extending even deeper, which forms the next leg of the pattern. Once again, price rallies up, retraces, and finally makes one more downward leg, completing the harmonic shape. Now, notice how the structure creates a series of symmetrical swings, almost like a butterfly's wings. These swings align with Fibonacci retracements and extensions, which are the backbone of harmonic patterns. The final downward leg into the red zone represents the potential reversal area. This is where traders start looking for buying opportunities, because harmonics like the bat, Gartley, or crab patterns often signal that the market has exhausted the move and is preparing to reverse. And that's exactly what happens here. After completing the final leg inside the red completion zone, price immediately reacts upward with strong bullish candles. You can see how momentum shifted. What was once a series of lower highs and lower lows suddenly turns into a strong uptrend. This confirms that the harmonic reversal zone acted as a high-probability entry point for buyers. The trading strategy here is straightforward. Traders look to enter long positions inside the completion zone, place their stop loss just below the lowest point of the pattern, and then target previous swing highs or Fibonacci extension levels for profit. This creates a favorable risk-to-reward ratio, since the invalidation is clear and the potential upside is much larger. So, this chart is a perfect example of how harmonic patterns aren't just theoretical drawings. They work in live markets to predict potential reversals with accuracy. The key is to identify the structure, confirm with Fibonacci ratios, and wait for price action signals like strong bullish candles before entering. Here we have a live example of the bearish 3 drives pattern forming on the AUD-USD 5-minute chart. This pattern is a powerful reversal setup that signals exhaustion in bullish momentum after 3 consecutive upward pushes. Let's break it down step by step. The pattern begins with point A, where the market starts its first bullish leg upward to point B. After this initial rally, price corrects down to point C, which usually retraces around the 0.618 Fibonacci level of the AB leg. From here, we get the second bullish drive up to point D. Just like before, the market then retraces down to point E, again typically respecting Fibonacci ratios such as the 0.618 retracement. Finally, we see the third and last bullish drive up to point F. This leg often extends to about 1.272 of the previous retracement, completing the classic 3-drive structure. The key detail is that each upward push is getting weaker in momentum, showing that buyers are running out of strength. Now, the shaded red areas in the image highlight the harmonic symmetry of the drives. Notice how each push and retracement is similar in size and proportion. This is what makes the 3 drives pattern so reliable. At point F, the pattern is considered complete, and this is where traders look for short, sell entries. The trading strategy is straightforward. Enter a sell position around point F. Place your stop loss just above point F to protect against false breakouts. Set your take profit near the retracement levels or the prior lows, like point C or E. This chart clearly demonstrates the psychology behind the bearish 3 drives. Pattern: buyers continue to push the market higher in 3 waves, but each time they lose more strength, and eventually sellers step in to reverse the move. So in summary, the bearish 3 drives is a high-probability reversal pattern that combines market psychology, Fibonacci measurements, and price symmetry. Spotting this setup on live charts, like this example, allows traders to enter with confidence at exhaustion points and profit from the reversal. Here we can see a textbook example of the bearish 3 drives pattern on the AUD-USD 5-minute chart. This pattern is a harmonic reversal setup that signals the end of bullish momentum after 3 consecutive upward pushes. The structure begins at point A, where the market makes its first strong upward drive to point B. After that, price retraces down to point C, before moving up again to point D, forming the second drive. Just like before, the market retraces down to point E, before finally making the last push higher to point F, which completes the third and final drive. Now, point F is where the reversal is expected to happen. Notice that the chart clearly marks the sell entry at 0.62613, exactly at the completion of the third drive. This is the ideal entry zone because the pattern indicates exhaustion of buyers and the potential for sellers to take control. The chart also highlights 3 take-profit targets for this short trade. TP1 at 0.62556. This is the nearest and most conservative target, ideal for quick profits. TP2 at 0.62522, a medium target, offering a better risk-to-reward ratio as the trade develops. TP3 at 0.62465, the most aggressive target, which maximizes profit if the market follows through strongly to the downside. The stop loss, while not explicitly shown here, is generally placed just above point F, protecting against false breakouts or unexpected bullish continuation. The red shaded areas on the chart represent the symmetry of the drives, and you can see how cleanly each leg mirrors the other. This symmetry, combined with Fibonacci ratios, makes the bearish 3 drives pattern a high probability setup. This image is a great demonstration of how to spot, confirm, and trade the bearish 3 drives pattern in real market conditions. Traders would enter short at the completion point, set a tight stop just above, and then aim for clearly defined profit targets, ensuring both safety and profitability in the trade. Here we have a perfect example of the bullish 3 drives pattern on the AUD/USD 5-minute chart. Unlike the bearish version, this one signals a reversal to the upside after 3 consecutive downward pushes. The structure begins with point A, where the market makes its first drive down to point B. From there, price retraces slightly upward before continuing lower into the second drive at point C. Once again, buyers step in, pulling the market up to point D, but the bears push back, driving the market down again to point E. Finally, we get the third and last drive lower, which completes at point F. Now here's where the trading opportunity comes in. At point F, the market has already completed 3 strong downward pushes, each time losing momentum. This signals bearish exhaustion and the potential for a bullish reversal. The chart marks the buy entry at 0.62527, exactly at the completion of the third drive. The profit targets are clearly laid out. TP1 at 0.62577, a conservative exit for quick profits. TP2 at 0.62609, a moderate target for a stronger move upward. TP3 at 0.62659, the most aggressive target, ideal for traders who want to maximize gains from the reversal. The stop loss, though not labeled, is typically placed just below point F to protect against false breakouts. Notice how the market reacts right after the third drive. It reverses strongly upward, confirming the validity of the bullish 3 drives pattern. This is why the setup is so powerful. It combines price symmetry, Fibonacci ratios, and market psychology to give traders a clear edge. So, that's the bullish 3 drives pattern in action. Just like its bearish counterpart, it's a high-probability setup that helps you catch market reversals before the crowd. The key is to wait for the third drive to complete, enter with proper risk management, and aim for structured profit targets. If you found this explanation helpful, make sure to like this video, subscribe to Financial Freedom FX, and hit the bell icon so you never miss future trading tutorials. And let me know in the comments, have you ever traded the 3 drives pattern before and how did it work out for you?